In today's video, we'll talk about how not a bailout is actually a bailout and how we're not out of the woods yet. I'm not a professional investment advisor. Please do your own research. These are just my personal opinions. These are the topics we'll be going over today. First, we'll talk about how Biden's administration claims on how this is not a bailout. We'll talk about what the FDIC does and why is it important here. Then we'll talk about the Fed bailout. Then we'll cover off with the bond market with yields coming significantly lower now, but yet still inverted for the yield curve. Then we'll talk about equity market and the dollar, how I think equity market is not out of the woods yet, and US dollar, unless we see a strong Fed, the US dollar will continue falling, the DXY will continue falling, possibly sub 100. Then we'll talk about precious metals and energy, how precious metals had a good rally, but I think we might, the next chance for a pullback might be next week's FOMC. With energy, continue under pressure with the recession pricing in. We really need a catalyst for energy to pick back up. China brokering peace deal in Middle East that provides more synergistic relations between those two and moving away from US, weaker US power in terms of a global stage. Then we'll cover off with the outlook. So Yellen came out on a CBS News interview saying that, hey, we're not doing a bailout again. Biden came out the next day saying that, hey, don't worry, no losses will be borne by taxpayer. All the deposits will be safe. Don't worry about it. And to me, that is just all bogus. Like, somebody has to pay the cost. As long as if the Fed is doing it, then you lose out in purchasing power for anyone that holds US dollar. If the federal government is doing it, they have to fund it by either more national debt, or they increase taxes. So either way, the taxpayers have to pay for any of the things that federal government is doing or central bank is doing. Now, why did these financials take on additional risk, right? Why are they on underwater? Well, either they know or at least they hope that they will be saved, right? Just like what happened in 2008. And similar to UK pension funds, when we were still in a zero interest rate environment, it pushed investors, or banks, when they, have all these deposits, it pushed them to search for higher yields because it's zero interest rate. Well, I, need to deal with whatever obligations I have. For example, like that's why UK pension fund was such a great example. If you think, it's just happening to UK pension fund, it's probably happening to other pension funds too. They have a obligation to be met on an annual basis. Like let's say 7% they have to pay out every year. And with a lot of pension funds, they also market to inflation. So as inflation goes up, their obligation increases more and more and more, right? 7, 8, 9%, whatever. But with low interest rates, where are they going to find, a return that can satisfy their obligation, right? They pushed into buying junk bonds, that because junk bonds yield higher because you take on more risk, or they use leverage, they borrow money to buy, not as risky investments. But as interest rates continue to go higher with the rate hikes, these assets are now underwater with unrealized losses, and that's why, all these financials are in trouble, right? Because interest rates are higher, yield curve is inverted, and now the assets that they hold that were purchased in a lower interest rate environment are now underwater. And when people are trying to pull money out of these banks, that's when they have to realize the losses and they're having more and more liquidity issues. Taking a look at FDIC, this is an entity that insures deposits that are in these bank and financial institutions. And what happens is originally it used to insure, I think, 100K prior to the 2008 crisis. But with that happening, the FDIC and federal government wanted to make sure people feel safe, so they increased the insured amount to 250K per account. How does FDIC operate is that they take premium on as a percentage of the deposits from the banks, and that's what is used to fund the insurance. It's only supposed to be used as emergency to avoid a bank run, because what happens is when you put money in the bank, they lend out a portion of it, only a portion stays, as reserve actually still being there. Most of the amount is being lent out. That's how a bank operate. That's fractional reserves banking. That's how they make money, by lending part of your money out. But if everyone comes to grab their money, that's when the bank has a bank run, because there's no money there. Now what happens right now is we are seeing the banks sitting on big losses. Again, we talked about this before, because the market price of their securities, their fixed income securities, are now underwater as yields move up. When yields move up, the existing bond price goes down, because let's say you had a 2% bond, but now interest rate is at 4%. So your bond is now trading at a discount. And what happens is, as more and more depositors are trying to pull money out of their banks, the banks have to find money somewhere. So if they sell some of these securities, that unrealized loss now becomes realized. And also, they don't have enough money to pay it. So let's say you're trying to pull $100. Well, my original $100 bond is now trading at, $60, $70. So I need to sell even more to make up for the $100 that you're trying to pull out. Now imagine if the federal government or the Fed having to pick up all this unfunded liabilities, all these uninsured deposit balances. That means there's even more funding required, more unfunded liabilities, taxpayer having to pick up the tab again. So Biden's claim that no taxpayer will bear the cost, that's obviously false. Someone has to pay the price. And again, if the federal government's doing it, everyone is paying the price. The Fed announced a new bailout program, the BTFP, Bank Term Funding Program. So previously, there's already a program called the discount window that has already surpassed 2008 crisis level. And what happens is, in this program, the discount window, you can only borrow for 90 days, and you have to borrow at market price. In this new program, BTFP, you can swap the discount assets for face value, so for a whole year. And any assets already pledged for the discount window can also be pledged for this new BTFP. So you have double collateral there. So the same collateral is being used for two programs for, not double the money, because discount window is at market price, but pretty much you get new money at face value even if you have already used the discount window. So what BTFP can do is, for example, a bond trading at $60, $70, doesn't matter, as long as it's a bond that is qualified, that include Freddie Mac, U.S. Treasuries, mortgage-backed securities, any qualified assets that, even if it's trading at discount, $60, $70, you can be pledged for face value of $100. So then the bank doesn't really have to take the loss effectively. This introduces moral hazard. Let's say you're a bank that weren't in trouble or not as deep in the water. Now you hear this. I have a bond that's trading at $60 and I don't have to take a loss. I can go pledge that asset, get the money, $100, and then immediately buy existing bonds at $100. Why would I not do that? Why would I sit on my unrealized losses but not take advantage of this, huge gift that's being given to me? I take the $60 bond, I get $100, I buy new bonds, at $100, but I get, the extra $40. Like, why would I not do that? And also higher interest rate. And so what this does is it somebody has to take the loss. So if the Fed is taking the loss, right? The Fed has been taking a loss, ever since they started hiking rates because they themselves hold a lot of these securities, but they hold till maturity. So what they so what they actually take is, again, loss of purchasing power to everyone else. And we also saw that the Fed balance sheet last week. So is this the sign of, the QE restarting again? Because we saw this as a aftermath of 2008, where we saw the balance sheet come down slightly to 3.8 trillion, but then it's rebounded ever since. So meaning they were never able to shrink the balance sheet for a long term. They tried it, it didn't work. Because the second you try to shrink the balance sheet, what happens is everyone who got a bailout is now failing again. And unless you let those fail, that's why you can't save anyone. You have to let people fail. Otherwise, the balance sheet just keeps growing and growing. You can try to shrink it, but unless you let people fail, the Fed balance sheet keeps going up. And we saw almost 300 billion increase, and that represents in 1 week. This is 1 week, and I don't know, and it starts counting on Wednesday. So I don't know if the Fed started bailing people out on Sunday or Saturday. Maybe next week we get an even bigger jump, and this wipes out last 4 months of tightening in 1 week. So we'll see if this trend continues, but unless the Fed really has determination to tighten and not continue to save these companies, eventually we'll see 10 like new all-time high in Fed balance sheet balance. Maybe we'll see 10 trillion. Taking a look at the bond market, so the US Treasury, we had a highest for 2 year, I think, at 5.058%, and we had a biggest drop since 1987 from CNBC. We had a huge drop within, it was 2-3 days for bond yields, and it's possible that investors are shifting into the recession mindset, right? They're buying bonds, they're selling stocks. And when it comes to the bond yield curve, I talked about this before, because it is inverted, that's why the financials are in trouble, because their cost is higher than revenue. Short-term yields higher than long-term yields. In order to normalize this yield curve, either there has to be a massive buy-in on the short end, bringing the yields down, or a massive sell-off on the long end, bringing the long end yields higher. Fed rate cuts will drop the whole curve. It doesn't fix the inverted situation. It drops both long end and short end. And so as the market is pricing in a 25 basis point hike now, and now rate cuts are back on the table this year, that doesn't help the inverted situation. We need more, either the Fed coming in, buying a lot more in the short end, or investors have to do more shifting from the equities market to the bond market. And that means more trouble for the equities market. At the same time, if the Fed has to be the person that buys up massively on the short end, that means, again, huge increase in the Fed's balance sheet. and inflation, because money printing uh, brings inflation. Inflation is a monetary phenomenon when it comes to the long term, because any price increase without the monetary base increase, that's only a short-term phenomenon. Uh, Supply and demand will fix that, assuming there's capacity. When we take a look at the equity market and the dollar, for the equity market, given the big sell-off, I did expect a bounce, but unless the Fed in next week's FOMC show less hawkishness, this rally will just be a dead cat bounce, and we're going way back down. And we're seeing more shift towards defensives, where investors, are starting to really price in the recession theme, where they're moving away from the inflation theme. We're seeing, energy fall dramatically. We saw precious metals rally quite well. We're seeing, you know, more and more people leaving from these techs, from these financials. We saw again a big rally in financials after the big drop, but again, we'll see if this continues. I mean, anyone who really bought in to these financials, either they know something, meaning like, oh, they knew the Fed was gonna save it. They knew federal government weren't gonna let these financials fail. So the really oversold situation was a perfect time for buy-ins. Taking a look at dollar, U.S. dollar is facing headwind as the market continue to price in now a less rate hike at 25 basis point instead of the 50, and they're also pricing back rate cuts, at the end of the year. So we might get a slight bounce with the FOMC, but without, a determined hawkish Fed, I expect the US dollar and the DXY to go sub 100 and a sustainable rally for precious metals to all-time high, because we already see Fed balance sheet, increasing again, unless that reverts. Right now we only have 1 week. We're seeing the increase, and with the dollar, with interest rates, if interest rates are taking a pause or even coming down later on, with Fed balance sheet already increasing, this is not good for the US dollar, but great for precious metals. Taking a look at precious metals and energy. For precious metals, we already saw a nice rally from what looked to be a short-term bottom. Maybe we'll get, one pullback with next week's FOMC meeting. Maybe with rate hike, and then Fed Chair Jay Powell coming out trying to be like, hey, we'll do the job, we'll keep tightening. And then in the weeks ensuing, we see, Fed balance sheet continues to increase, right? Money printing is back on table. And then maybe a more sustainable rally to all-time highs. So again, it all really depends on the Fed rates going forward, and if QE is really truly back on the table, whether it was just a 1 or 2 week kind of thing, or do they have to keep doing it every week, and we don't see the shrinking continuing. For energy, they continue to be under pressure from the recession price in. We saw Brent crude did break below 77 for the weekly. This is not a good sign. And we're really looking for a catalyst going forward for a sustainable rally. Again, long term, I think oil has huge potential because of the lack of sustainable reinvestment from the U.S. end. And when it comes to Russia and Middle East not having as good relations with the U.S. and U.S. dollar, they're trying to move away from it. Russia already did. Middle East is working towards that. And with all that in mind, I think oil prices, energy price has to go, a lot higher. But when is that happening? Don't really know. Really looking for a catalyst. Now let's talk about the China brokerage peace deal. China did that between Iran and Saudi after a 7 years dispute. How normally US is the one that's kind of policing everything in Middle East, But now, as China is getting close with Middle East, this provides synergies where China, even though they're trying to move away from fossil fuels as well, but in the short to medium term, that can't happen immediately, right? They're building a lot of nuclear factories, but nuclear power plants, but that is a long-term process, right? In the meantime, they still need fossil fuels, and they're trying to get that from Middle East. They're making good relations, and with Middle East, they are also trying to prepare themselves when it comes to the post fossil fuel world. As the world move away from fossil fuels, they want to make sure they have enough infrastructures, they have enough capital, that they're ready for when they can't rely on selling oil anymore, and they can get that from China. And so China needs energy, Middle East needs infrastructure, and they can help each other. And that pulls themselves. They make a nice, relationship there, and that takes U.S.'s power away from the world, and also potentially to leave the U.S. dollar, because oil trades with the U.S. dollar. But if China and Middle East can just buy, maybe pay in RMB or in Middle East country in their own currency, right? Again, that takes power away from US. It gives more power towards China and its allies. Taking a look at future outlook, equities, in my opinion, are not out of the woods yet. Normally, when the yield curve normalizes, that's when we have the last leg of the bear market. In 2008, there were multiple rescue efforts by the Fed to, banks like Bear Stearns and Lehman Brothers, but they still exploded. With Bear Stearns being bought out, Lehman just going bankrupt. And what that means is, in this case, the Fed is already starting to save the banks. Will the banks really be out of trouble now, or are they going to fail again in the future? Unless the Fed can do something with the inverted yield curve, or they just keep lending money, I guess. They just keep lending money, more and more lending, more and more programs to give them liquidity, then I guess the banks can just keep going. So I think what the Fed is trying to do is trying to delay the financial crisis as much as possible by looking possibly restarting QE, while still trying to keep hiking rates to deal with the inflation problem. We'll see how long the Fed can really juggle the two, but eventually the Fed has to make a choice. Either to let people fail, fight inflation, or surrender to inflation and, try to save everyone. With more troubles ahead for equity market, with SPACs, CLO, meme stocks, real estate funds like Blackstone, we talked about it before. These are all things that could still happen, could still implode. For the FOMC next week, Fed has to keep raising rates to avoid inflation returns. We already saw with the February CPI report being quite sticky, meaning we didn't see the more drop in inflation. More importantly, the core inflation number, it's being really sticky. It's not really falling by much. And again, the Fed's trying to use QE to avoid a financial crisis by shoring up liquidity for all these financials. They have to make a choice. Either stick to fighting inflation, let companies fail, no bailouts, or they'll surrender to inflation and start cutting rates. In my opinion, I think eventually the Fed will surrender to inflation, cut rates. We'll see massive big rally in equities, in precious metals, in commodities, and then eventually, then when they hit the point where printing more money, there are no more rate cuts to cut, but prices are still falling. Financial asset prices are still falling. Stocks are still falling. At that point, that's when they call it quits. And that's the final, the beginning of the Greater Depression. But until then, we're waiting for the Fed to fully pivot. Then we'll see, big rallies and everything. And then once that rally's over, any more money printing doesn't help financial asset prices, doesn't stop them from falling, then the Fed will pull the final trigger. Then we'll have the Greater Depression. Thanks for watching.